I guess you have to. It's hard to say, but to sit here and think like, I guess to sit here and say like, oh yeah, this is cooked. Like, bonds are cooked. I almost think like you're making a pretty fucking hard statement to say that. Like, the only treasuries on the planet of the Earth that are deemed respectable are now worthless. And if that's the case, then like, if the
Well,
bonds
not
are worth,
worthless. It's just relative to gold, they're not as valuable because they have that default risk that's constantly rising. Like, don't you think the market maybe realized, like before, we've always had deficits. It's always been an issue. It's been an ongoing issue for a very long time since QE.
it started happening after COVID though. Like, look at this. 21.
Yeah.
I think what
So
happened is the Fed
isn't the
started raising
market
rates.
just kind of, yeah, the market's realizing like, okay, this debt's fine until they start raising rates, and now the market just realized, oh shit, actually this debt's not okay when you're not in an insane QE 0% interest rate environment.
Right. And I guess what I'm trying to say is like the typical trend of this country is disinflation slash deflation. So rate cuts are coming.
It,
Like,
don't you think maybe the market is just kind of shell shocked by what happened?
yeah, sure, but like, I mean, if you just look at anything like 30 years, right? Like, look out long enough, right? There's a disinflationary force.
Yeah.
In it's because we innovate faster than we can print. I'm not even joking. So what happens is inefficiencies rise faster than governments can hand out money. And there's a lot of people that talk about term premiums and shit like that, but like that all that really is like an excuse on why yields are low. The reason yields are low is like the government could sustainably issue a lot more debt. That's all that's going on here. They're not. There's like a scarcity there. And because there's a scarcity, I think maybe that's why bonds are like being propped up when like they could be in a situation where like inflation's up, but inflation was up, now it's coming down. The question is like, does productivity falter? And I think that's what like we need for bonds. And to say that bonds are forever going to underperform gold would assume that there's never going to be a recession, where the default risk is so far gone because like everyone's eating the debt because it's everyone wants the debt because it's the best paying thing in town. And I
But
think
if
that
default
like,
risks are gone, why, like, what is the reason for credit default swaps to be
no,
rising right now?
default risks are not gone right now. They're elevated. They will stay elevated as long as rates are high. Rates are higher than where they should be, is our opinion. But like rates are also high enough to the point where they're affecting implied probabilities of, or sustainable paths of government spending. And that's why like, see, the reason is I don't think the reason why the government can currently not, and not you, we were talking about this earlier. The reason why the government can't run these crazy deficits indefinitely, like, is because it's the end of the day, without a recession, the Fed is going to hold rates up to basically cushion inflation or to erode it, prevent inflation, right? So there comes a point where the government can try and print as much as they want, but the interest rates are going to be so high where like they're not going to be able to get through budget meetings without accounting for the fact that interest expenses are way too fucking high.
Yeah. But what's that
And
level? Like, don't you think
um
that the gold and bond ratio can continue higher before we hit that level?
yeah, we could, but like at the end of the day, I think that you're going to run into a point right where, so look at it like this. The gold and bond ratio can go up. It can continue to go up. But at some point you're going to have a reaction to that, which is you're going to be met with some sort of, maybe it's a recession, maybe it's whatever, more than expected rate cuts, and CDS swaps are going to come down. CDS spreads, right, are going to come down because the rate is falling, so the risk of default falls, and in that point, you're gonna have somewhat of an unwind of that trade. That's not an indefinite trade. I feel like the gold bond thing is situational, given that the Fed is playing hopscotch here on if they're going to cut rates or not. One cut, two cuts, no cuts, who the fuck knows, right? And like now, um, CDSs are getting jammed up. Number one, because we have an election coming up where 4 years is a big deal. It is, but like in the grand scheme of things, the fact we have independent Fed helps with this because you have Powell saying like the government has to handle their own deficit problem. Like the high interest expense is not the Fed's fault. But I agree with you. It's not fucking easy looking at bonds and like looking at gold and like wondering like, yo, what the fuck is going on here? Like, I mean, look, just look at it like this. Gold, we take a look at gold. This is a beast chart. Look at this fucking thing. Things up every day.
Yeah. And so,
So
like, is it really default risk that's causing this discrepancy?
I think so. I would assume so because I would assume that there is a fear of continued deficits and a fear of interest income rise interest so the longer the Fed holds rates at a higher level, the more interest rolls up at a higher rate, right?
Yeah.
The more so like the slower the Fed and the slower the cutting cycle is portrayed as, the higher the default risk is going to be. So if you lift the Fed funds floor, the CDS is going to go up.
That's exactly what we saw in
Yeah.
the last couple
So
of weeks.
I'm thinking that's probably where we are right now. We're in a position where like in a way it's almost like the market's telling you like the Fed's too high in a way if you really think about it. Like CDSs are moving at elevated levels because the Fed is holding rates. Well, maybe the Fed is not too high, but maybe the government spending is too much, right? It's starting to come up in the CDSs.
If we do get a recession, obviously that implies rate cuts. Like, is that going to be bringing CDSs down, or is a recession going to push them even higher? Because growth
No,
is
no.
growth gets
A recession would probably crush CDSs.
yeah. Okay.
Realistically, as long as it's not a GFC like type style thing where you have like the fundamental like as long as it's not a financial crisis, a recession should put some brakes on CDSs and therefore kind of reset the golden bond trade in my opinion. Because like if you look at CDSs, right? And you look at what happened, GFC, this whole thing blew out, right? And obviously, right, at that point you didn't know if the banks were going to be around. You didn't know what was going on. Initially, bonds ripped, but then like as CDSs really start, like we can even like look, bonds initially rip, right? And what you'll notice is like once CDSs like really go up, like bonds are like, oh no, no, because they're like, you know what? If there's a default, then my paper's worthless,
Yeah.
right? So they get the initial rip, and then they realize like it's bad, and they crash. Meanwhile, gold chugs because there's no default risk. So I think in a regular recession or a slowdown, like you can even look at in 2018, right? Even look at look in 2014. Any of these like where CDS is like fall, like you'll notice that like the bonds and gold like do actually bonds. The lower CDSs go, the more call it
It's like
risk off.
room for growth. The lower it
I wouldn't.
is, it's like it's easier for bonds to move higher.
Yes, yes. The best way to simplify this is to look at gold and look at bonds as individual assets, right? And then they're connected in the risk-off fashion. They're risk-off assets, but look at them independently. And then let's just say each of them has a power of one, right? A power unit of one to risk off, like one being risk off, zero being just a waste of an asset, right? So both of them have one. When CDSs are low, think of some of that power that gold has being shifted over to bonds. So bonds actually do much better in a low CDS environment. But as CDSs lift, the complete opposite happens where you shift over that power of bond, like where maybe gold was overweighted. or excuse me, where bonds were overweighted, that shifts over to gold. Now gold is more overweighted because there's just more uncertainty in bonds, and I think a lot of this stuff gets exacerbated as well in the fixed income space, because fixed income is like fixed income, right? It's supposed to be like the known. It's supposed to be like, okay, I'm getting these payments. Like, yes, I have to worry about default risk, but like when you start adding all these risky variables into the treasury market, I think it's easier to start moving and hindering performance, because it's like, CDS is going from like 10, 15 to 43. Here we're talking about like a 1.5 to 3% probability, a default probability. So we're shifting, pretty much doubling the default probability off the lows, and the correlation immediately breaks down between gold and bonds, where gold starts really outperforming bonds just on a 1.5 percentage point move in default odds.
Yeah, because all of a sudden it's not a risk-free asset anymore.
It is, but yeah, you're right to say that. It is risk free to the sense that 3% still like 3%, but you're talking about something that, like, I think the populace has an idea of being 99% guaranteed,
Yeah.
right? So it's like, oh, now it's not, you're 99.9% guaranteed and no default. Like, the safest thing you could own is a U.S. Treasury, right? Um, Now it's like, well, maybe not, and now it's like, oh, well, what has no default risk? And obviously gold. And some people are trying to make the argument that Bitcoin's going to be the new gold, but
So
I think that's a bit
what
of a
needs to
stretch.
happen for CDSs to just get whacked and the bonds to completely reverse from here?
You mean bonds going up, right?
Yeah.
Yeah, I know. I mean, listen, man, we're along these things, so I get it, but you have to appreciate the fact that we have an election coming up, and or at least understand it. It's tough to appreciate these drawdowns, but you have to understand that there's an election coming up, and with that, there's going to be uncertainty, especially on the path of interest rates. Um, what does government spending look like? Some people say Trump's a big spender. Some people say he's not. Some people say deficits are great. Some people say they're bad. Right? There's obviously a lot of conflicting things. The general understanding of economics is if you have oversized deficits with an okay economy, what's going to happen is you're going to end up generating inflation.
Well, I think there's like
And
two sides to it. There's the growth side of it, and then there's the Federal Reserve side. So like now that we had rate cuts getting priced out, we see this movement up in the CDS, but growth is still there. Once growth diminishes, if that ever happens, if this is truly like a recession that's coming, growth deteriorating is what's going to bring down those CDSs.
well, for sure, because what's going to happen, right, is the reason CDSs are lifted as they are is because the Fed, like, no matter how we want to look at it, the Fed has a floor right now above 3%. The Fed's peak in 2018 over here was 2.5, and they were in the ones. They were in the ones before COVID even hit. Right? So it's like we're at 4 and we're bottoming at 3 over the next 2 years. If government spending is going to remotely even continue at its path, well, interest expenses are going to continue to grow, right? So if that's the case, well, we have to start lifting like default probabilities, because obviously conditions are a lot different, right? You have a ramp now of interest payments that are considerably more expensive than where they were in 2018, 2019, right? So now those are up. And the only way to get those rates down without cutting into an actual slowdown and reigniting inflation is to have a recession or a slowdown. So that's where we are in terms of how rates have to shift. I think rates go down, CDSs go down. At least, better put, Fed funds floor drops, CDSs drop, therefore bond and gold correlation kind of resets. Now, if you think CDSs are going to accelerate and ramp up from here, well, then gold will continue to outperform bonds every day of the week.
Yeah. Well, shit. Looks like we should have bought gold. Peter Schiff was
Yeah,
right.
Peter Schiff was right, dude. Listen, now, let's take this. Let's take this a step back. There is a bonds were doing well for a couple of weeks, or at least a
Like,
couple of months,
yeah,
right?
like 2 months, I think.
And I think like this shock is what broke the bond and gold. Like if we look at gold and bond ratio, you'll notice that like it was like deadlocked for a while. And
Yeah.
this CDS spike is what ignited the leg. So the question is if the CDS spike returns, I think you're going to get another like range bound price action on this on the
Well,
ratio. Meaning you're
range
going to
bound,
get
or is gold going to pull back as money gets allocated into bonds instead of gold?
that's possible. So like yeah, you can make the argument like why don't we just chase gold, right? Like let's get long gold. But like I don't think I don't think it makes the most sense to do that. Right? Because like you're not going to pivot out of bonds into the lows to go into gold, where the ratio itself has extended itself, right? Like look at it, it's legged up. So we're at the we're, like in terms of gold is significantly outperforming bonds over the last like, couple of weeks. And you're going to leg into this now. And if CDSs fall or just roll over, I mean, we got what 3 weeks to the election? Maybe the election goes by and CDSs come in. And then what?
Yeah.
Like, you're left holding gold. Maybe gold pulls back, right? Gold goes sideways. Money moves from gold into bonds now when there's more clarity. I mean, look, like this type of move in CDS is pretty aggressive. It's not like it's one print too. It's not like it's like one of these, like where it's like, oh, we're up for a day, down. Like this is like going on for like a month now. And in turn, like bonds literally rolling over as CDSs start ramping. Gold doing its thing. So yeah, pretty interesting.